Hello everyone, in this video I'm going to solve the reading quiz chapter 14 questions. In this chapter we'll learn about money and banking, and the first couple questions is about functions and characteristics of money. Money is an asset that you use to purchase goods and services, and as we said, money is an asset and this asset has some characteristics so that it could be considered as money. First of all, money is a medium of exchange. Money, medium of exchange. So that means you need money to buy goods and services. You exchange money to buy goods and services. Second, money is a store of value. That means you can keep the money at home, let's say $500 set aside, and 6 months later still you can buy goods and services with $500. And the third one, money is unit of account. Money is a measurement, measures the value. So when you see that the price of apple is $2, that means the value of the apple is $2 compared to a sports car, maybe $50,000. So it measures the value of the good to a buyer. Therefore, it's called unit of account. And let's read the first question. Which of the following is not considered a characteristics of money? First one, it's medium of exchange, so it's a means of payment. Second, it's a store of value, therefore it can be used to make future payments. And we also say that money measures the value, therefore it's a unit of account. But the option, it says it must have intrinsic value, is not correct. The reason is very simple. When money has an intrinsic value, then we consider an example of a gold. Gold was used as a money in the past, but also gold has its own value if it's not used as money. So not all monies have intrinsic value. For instance, fiat money, which is the paper money, doesn't have any intrinsic value. It's valuable because government has an official signature on it. But if there is no signature on it, then it's just a paper and doesn't have any value. Question number 2. When $100 is deposited in a bank, which of the following can happen? So now the second question is about banks and banks' T account. Banks have T accounts. On this side, the banks has the assets, and on this side, the banks has the liabilities. So liabilities are the accounts that banks owe to somebody, and assets are the accounts that banks own it. So this is own, this is owe. And now let's look at what are the liability accounts for the banks. If you deposit money to a bank, then whenever you want to get your money back, the bank has to pay back to you. Therefore, deposits are actually the accounts under liabilities. And these deposits could be used as loans. Some other people, let's say you have a small business and you need to expand your business, you need money, you go to the bank and borrow some money. That means loans are assets for banks because you have to pay back and banks own this money. And also banks has a reserve account and they keep it for daily transactions. They don't lend this money, they are just keeping it to cover the expenses or spending of daily transactions. So therefore, this is an asset account as well. And here we have net capital. Net capital is the equity of the bank owners. So this account is under liabilities because it's an accounting identity. Assets are equal to liabilities plus equity. So a healthy bank should have a positive equity. When you have positive equity, liabilities are less than assets. So banks have enough assets to pay back its liabilities. So now let's understand this question. When $100 is deposited in a bank, which of the following can happen? If $100 are deposited here, the deposit account is going to increase by $100. And now we know that as an accounting identity, sum of this part should be equal to sum of this part. Let's read the first answer. If reserves are 100 and loans are 100, just I'm writing it here, 100, then this becomes total 200 and liabilities are only 100. There is a mismatch. That's not correct. So we can't have loans and reserve increase by 100 when you deposit $100 into the bank. So the first answer is not correct. Second answer, banks reserves increase by 10 and loans increase by 100. 10 and 100, 100 plus 10 is 110, but you have $100 of deposits. For that reason, this is not correct as well. Now let's look at the next one. The bank's reserve increased by 100 and loans increased by 10. Again, the same scenario. The total assets will be 110, liabilities 100. There is a mismatch. And the bank's reserve increased by 10 and loans increased by 90. Then it makes sense because 10 plus 90 is equal to 100. I have $100 of deposit, and at the same time my assets increase by 100. So as a result, if liabilities increase by 100, assets at the same time increase by 100. This is an accounting rule, so therefore the right answer is the last one. Question 3. When you purchase a t-shirt for $25, money is serving which function? And in this example, the money helps us to buy goods and services, therefore it's medium of exchange. Question 4. When you take a vacation and keep cash with you in case you might need it, money is serving as a store of value. Why? Because you are keeping it and you know that in the future you can be able to spend. So it keeps the value, it stores the value. Question 5. What is not a component of money supply M1? So let's remember what money supply M1 refers to. M1 refers to the most liquid money. That means these are the assets that you can easily turn into purchasing power. So you can go to a store and spend your assets if it's in the M1 category. Therefore, being liquid is the key point for M1. If that is the case, then M1 includes checking accounts and currency. Currency has two components, coins and cash. And also recently, the Federal Reserve adds saving accounts to M1 as well. Traveler's check is M1 too. Saving accounts become more liquid with the advancement in technology. Now some saving accounts let you even write checks for your spending. Therefore, checking accounts, currency, saving accounts are all considered as M1, and gold certificates as well. And M2 represents everything in M1 plus less liquid accounts. Less liquid accounts like money market mutual funds. So what is a money market mutual fund? In money market mutual fund, you are actually buying funds, but these monies from all depositors are collected in a basket to buy different types of government bonds. So when these assets return increases, you get return as well. Money market mutual funds. And what else we have under this? Certificate of deposits. So what is certificate of deposits? For instance, you want some return on your saving account and you promise not to withdraw the money for 3 months. So this is a time deposit example. And when you keep your money 3 months, you get a better return than any saving account that doesn't have time restriction. So therefore, certificate of deposits are also M2. So given this, the right answer is certificate of deposits because it is M2. Question 6. What is the size of M1 money supply? Now in this question, we are going to calculate the size of M1 money supply. And now let's identify each account, whether it's M1 or M2. The first one, checkable deposits, is M1. Small time deposits, as I said, you have to wait for some time to be able to use the money, therefore it's M2. Currency is M1. Money market mutual funds is M2. Saving deposits and money market deposits accounts recently were considered M1. Money market mutual funds held by individuals, doesn't matter it's held by individuals or businesses, they are M2. So now I'm writing again M1 checkable deposits, which in this case $600, plus currency $500, plus saving deposits and money market deposits accounts, which is 2,500, and that will equal to 3,600. As an exercise, we can calculate M2 as well. So M2, everything in M1 plus small time deposits 700 plus money market mutual funds held by business plus money market mutual funds held by individuals. So that is M2. and that is equal to 2,700 plus 3,600. 6,300 is the total amount of M2. So for this question, since it's asking M1, the right answer is 3,600. Question 7. If 2,000 is withdrawn from the bank by a customer, so remember, if we withdraw money from here, which in this case $2,000, not only liabilities will decrease, but assets will decrease as well. When liabilities decrease, assets decrease as well, keeping the net capital constant. For that reason, liabilities and asset decrease is the right answer. Question 8. If consumers decide to hold less cash and rely more on credit cards, other things equal, M1 is going to fall. Because cash is M1, but credit card is not a money. Since people are now holding less cash, M1 is going to go down, and credit cards, which is not belonging to any category, is going to increase, which is a debt. So it's a type of borrowing from the bank in a short period of borrowing money. Therefore, credit cards are not considered as money. Question 9. Banks earn money by making loans, and we need to find out all the answers that are actually fits to this. So how they are making money? They are going to get your money, like you deposit money into the bank, but they are not going to keep that money in the bank, because money staying in the bank is not making money. They are going to give this money as a loan to other people. Therefore, they are going to charge interest on the loan, and that interest earning is their income. But it's not the only way they are making money. By keeping their reserves, so some of the money you deposit, they keep at the reserve account, they can earn interest. So maybe let's say out of $100, $90 they give as a loan to the public, $10 they keep it for daily transactions, but $10 also earn interest because Fed pays interest on these reserve accounts. So 2 options are correct. And finally, question 10. Banks create money when they make loans that are deposited in the banking system. So this part is explained very well on your textbook, but I want to quickly explain here as well. So how banks create money? Banks create money by making loans. So let's start with one example, very simple example. In this example, we have, let's say, First Bank, and you need to borrow money because of your small business, right? And you borrow from the First Bank $10 million. And you're not going to keep $10 million cash at home, and you deposit that money into Second Bank. When you deposit this money into Second Bank, the deposit account is going to increase by 10 million. But this 10 million is going to increase the assets as well. Reserves are going to increase, let's say 1 million. And 9 million, the bank is going to use it to lend money to the public. Why? Because they can make money out of that by charging interest on the borrowers. So here, if you look at now the total amount of money in the economy, 10 million you can use because it's your account, which is a demand deposit. And 9 million, let's say, Sarah borrow from Second Bank, and Sarah can use 9 million too. So out of thin air, the bank's creating money and increasing the money supply to 19 million. So here we are not creating wealth. We are creating assets that people can purchase goods and services. But it's not going to be the end of story. Sarah is going to deposit this to another bank. Let's say this time Third Bank, and 9 million is going to be deposited. Third Bank is going to keep some of it as reserve, let's say 0.9 million. And then the remaining 8.1 million will be given as a loan. Again, the money supply continues to increase because initial 10 million you can spend, and then 9 million Sarah spends. And also, let's say this is Kenneth. Kenneth spends 8.1 million. So the money supply continues to grow. So this is how banks create money. So that's all for today. Thank you for watching this video.